The broadcast is now starting. All attendees are in listen-only mode.
Thank you all so much for joining us here on CPA Academy. This is Jason Bookman. I am happy to be your moderator on today's webinar on the best practices in accounts payable tax compliance with KPMG. We have Laurie Hatten-Boyd of KPMG and Anand Misra of Tipalti who are going to be guiding you through the next hour. And before we get into the webinar, I want to go through some quick technical checks and some housekeeping, make sure that everything is working for all of you in the audience. So if you haven't already done so, let's go over to the questions section of GoToWebinar and let me know in there that you can hear my voice and see the title card of the slide should be up on your screen right now. While you're in that questions section, please feel free to let me know where you're listening in from. We're just checking that everything is working through GoToWebinar. So far, I see a lot of responses coming in, so glad that you can all see and hear. Of course, if anyone is having trouble seeing or hearing throughout the webinar, go ahead and let me know in this questions panel. I'll do the best I can to get your troubleshooting done quickly and put your focus where it needs to be. Please, however, keep in mind there are a lot of you and there is only one of me, so I'll get around to all of you as fast as I can. Now on to a little bit of quick housekeeping regarding polls and credit for this webinar. This is a 1-hour webinar. Qualifies for 1 CPE credit for CPAs and 1 CE credit for IRS enrolled agents and PTIN holders. The way you earn that credit is fairly straightforward. Just stay logged in for at least 50 minutes out of the 60 minutes of our allotted time and answer the poll questions. We're going to have 4 polls throughout the webinar. You only need to answer 3 of those 4 polls in order to qualify for full credit. We, of course, recommend you answer all 4 polls. Polls will pop up on your screen periodically, and when they do, all you need to do is hit the button that best corresponds with your answer in the GoToWebinar poll box, and then hit the submit button on that poll dialog. Again, you need to answer 3 out of 4 polls in order to qualify for full credit, and we here at CPA Academy are going to use those polls and your time logged in to issue credit. CPE will be issued by the end of the day today and available in your CPA Academy account within 24 hours. CE credit will be issued with the IRS at a later date. So if you are a PTIN holder, please make sure that your name and PTIN are input correctly in your CPA Academy accounts in order to minimize any trouble we might have reporting your credit to the IRS. Now that we've gotten through all of the introductory housekeeping and I know that everyone can see and hear, I'm going to go ahead and turn it over to our presenters. So let's give a warm welcome to Laurie and Anand.
Hello and welcome everyone. Thank you for taking the time today to join us for the webinar, Best Practices in Accounts Payable Tax Compliance with KPMG, sponsored by Tipalti. My name is Anand Misra, and I'm the Director of Product and Partner Marketing at Tipalti. So let's kick it off. We have today Laurie Hatten-Boyd, Principal at KPMG's Washington National Tax Practice and heads of the firm's Tax Information Reporting and Withholding Group. Laurie is a subject matter expert and a thought leader and routinely engages in wide-ranging withholding tax service advisory services to assist both financial and non-financial institutions in complying with their U.S. tax information reporting and withholding requirements. She was acknowledged as one of 10 prominent people in tax and nominated by Tax Notes Today as 2011 Person of the Year. Prior to joining KPMG, Laurie was an attorney advisor with the IRS Office of Associate Chief Counsel International, where she worked exclusively with Section 1441 withholding regime. Laurie is a frequent speaker on foreign withholding issues and has authored articles appearing in International Tax Law, The Tax Review, and The Tax Lawyer. She's a member of the Washington State Bar Association. Laurie has a JD degree from Gonzaga University and an LLM in tax with distinction from Georgetown University Law Center. Welcome, Laurie. And my name is Anand Misra. I'm the Director of Product and Partner Marketing at Tipalti, where I'm responsible for driving messaging, positioning, and product launches. Prior to Tipalti, I was the Director of Product Marketing with Oracle NetSuite, a leading cloud-based ERP solution, and I have over 17 years of experience in product marketing and product management. So I think with that, I would like to welcome Laurie. The floor is yours. Take it away, please.
Thanks, Anand, and welcome everyone. I'll just get right into our agenda here. First, we're just going to talk very generally about Section 1441 and what compliance in that under that regime looks like. Then we're going to discuss some persistent misconceptions in this area, followed by just a very brief update with some COVID impacts. And then more importantly, I think to probably all of you in your jobs in this space, talk about what the IRS is doing in this space. So first, we're going to start off with the polling question. The very first polling question is, when do you collect tax forms from suppliers?
All right, poll question number 1 is now live. Everyone go ahead and answer poll number 1. We're going to have 3 more polls following this one. Everyone make sure that you get your answers in by hitting the button on the GoToWebinar poll box, followed by the submit button. This is poll question number 1. We're going to have 3 more polls after this one. We're going to close out of this poll in 3, 2, and 1.
Okay, now I'll just head right into an overview of the 1441 regime. Section 1441 is Chapter 3 of the Internal Revenue Code, and it's when you're making FDAP, fixed, determinable, annual, or periodical payments, and we'll get into what that means in just a moment, to non-U.S. persons. So if you look at this slide, we've got 2 different payment streams of these FDAP payments. And on the left side, we've got payments made to U.S. persons. To the extent the person is a U.S. non-exempt recipient, you're going to get their TIN in the manner required. And I say that because sometimes a Form W-9 is required. Other times you just actually need their TIN. If you don't have the TIN in the manner required, the tax identification number, you're required to impose backup withholding at a rate of 24%, and then there's reporting on a Form 1099. For this regime, that's Chapter 61 of the Internal Revenue Code, that backup withholding and the reporting covers U.S. and non-U.S. source income. So we're going to focus today on the right-hand side of this diagram, and that's the same FDAP payments made to non-U.S. persons. In this case, we're actually only focused on U.S. source payments, and we'll get into what that means again in just a few moments. The withholding, the starting point for the withholding, it's a gross basis, statutory 30% rate of withholding. Then there are certain code and treaty exceptions to the extent you've got proper tax documentation. And with respect to these payments, the reporting would be on a Form 1042-S. It's just the international equivalent of the domestic 1099 form. And then the United States uses that information from those forms to exchange with their treaty partners when there's a decline made. So I mentioned the starting point for this 1441, it's U.S. source income, statutory 30% rate of withholding. The character and the source of the payment is the responsibility of the withholding agent. There are mandatory presumption rules in the regulations that say if you're not able to reasonably determine the source, it's going to be presumed to be U.S. source, which means you're going to have withholding at that maximum rate. The year-end reporting, the Form 1042 is the tax return where you're reporting these payments and the tax withheld. The due date for that form is March 15th. It can be extended automatically for 6 months by filing Form 7004. The information returns, the Forms 1042-S, one copy goes to the IRS, one copy goes to the recipient, just like the 1099. Again, that due date is March 15th. Here we can get an extension, but not that automatic 6 months. You can get an automatic 30 days, and there's 2 different processes here. You have to file Form 8809 to cover the IRS copy. For the recipient copy, you actually have to send a letter to the IRS Martinburg Computing Center, and the address to that is in the instructions to the 1042-S. There is an ability to request an additional 15-day extension. That is not automatic. Given the COVID situation, the IRS is obviously going to be a little bit more liberal, but normally there had to be something very catastrophic happen at the withholding agent level. So, documents got destroyed, files got destroyed, things like that. But historically they gave that extra 30 days just routinely, but that's not the case anymore. So really you could count on the 30 days. So then we say, why do we care about all this right now? And it's really because the IRS cares. They've got a very aggressive audit campaign going on in this space. For them, it really is the low-hanging fruit. The exams are quite easy for them. if you don't have the proper documentation or if you haven't followed the proper compliance processes, the withholding agent is liable for the tax that wasn't withheld. And so for them, it's an easy way to audit and an easy way to get money. And we'll talk about very details about what the IRS is looking for on audit and what we're seeing and experiencing at the end of this presentation. So now we're just going to talk right down into the nitty-gritty about what all this is. So what is fixed or determinable annual or periodical income? It's really any income other than income from the sale of property, market discount, and option premiums. So it's going to include compensation for services, rents, royalties, interest, prizes, awards, anything of that nature. As far as the sale of property, there is one exception. If it's the sale of an intellectual property right, an IP right, and the sales price is contingent on future use, those payments, instead of being treated as sales proceeds, which would not be covered by these rules, they're actually going to be taxed as a royalty. And so you would withhold 30% unless there was a royalty article in a treaty that was applicable that you could reduce the rate from. So the source of the payment. The source of the payment is very important. As I mentioned up front, determining the character and source of the payment is the responsibility of the withholding agent, and the regulations have a mandatory presumption rule. If you can't determine, it's treated as U.S. source. So I have an example here where a contract's entered into, there's going to be some services performed, but there's an upfront payment, and you don't know at that time where the services are going to be performed. You're going to have to presume they're U.S. source, and there would have to be withholding on that. There are certain escrow procedures you can use in certain cases to alleviate having to deposit the tax withheld with the IRS until you're able to determine that, but they're very limited in use. And this is one area that I will just focus on right here because the IRS is very aggressive with this on exam. They want to see that non-U.S. person either stating in the contract, the statement of work on the face of the invoice, or a separate statement from them certifying that the services were performed outside the U.S. or if partially in the U.S. to give that allocation information. And they want to see that in writing. Otherwise, they just go to the presumption that all of the services were performed in the U.S. So documentation, we're going to talk about that for a bit because documentation is really the cornerstone of the Chapter 3 withholding regime. The documentation you get is going to be how you as the withholding agent determines, am I paying a U.S. person or a non-U.S. person? Is that person the payee or the beneficial owner? And what that means, the payee, for example, would not be the one that would take the income into account for U.S. tax purposes. So for example, a partnership would be a payee. The partners would be the beneficial owners because they're the ones that would be reporting the income. And this is all going to be determined by the tax documentation. And we'll go through each form in just a moment. The tax documentation is going to help you to determine whether you have to withhold at that statutory 30% rate or if I can reduce it because of a treaty claim or a code exception. And the key here is the documentation has to be on file prior to making that payment. Again, the regulations cover all these scenarios where you don't have documentation or you can't rely on the documentation because there's something wrong with it prior to making the payment. The regulations have presumption rules that have to be applied. And as you could imagine, those presumption rules are going to result in the maximum rate of withholding being imposed. And now we were on to a second polling question, and that is, which tax form do most of your suppliers submit?
All right, we've got poll question number 2 open. Poll question 2 is live. Everyone go ahead and answer poll question number 2. If you're having any trouble answering the poll questions, go ahead and let us know in the questions area. We are going to do the best we can to make sure that you are all able to answer your polls to qualify for credit. Again, this is poll question number 2. We're going to have 2 more polls after this one. We're going to close out of this poll in 3, 2, and 1.
Okay, I'll move on now. So now, as I mentioned, I'm going to go into each of the types of forms that you may be receiving from a supplier. Obviously, the W-9 from a U.S. person, and I don't have that listed here because we're really talking about payments to non-U.S. persons. So we've got the W-8 BEN. That is going to be provided to you by an individual. They're certifying that they are the beneficial owner of the income. They're a non-U.S. person, and they can use that form to claim treaty benefits if they're so entitled. The form was bifurcated back in 2014 when FATCA came to be. So now before there was just a W-8 BEN for any non-U.S. person that was claiming to be the beneficial owner. But now we have the W-8 BEN-E for entities. So again, they're certifying they're a non-U.S. entity. They are the beneficial owner. And again, they can use that form to claim treaty benefits if they're so entitled. We've got the W-8 ECI. That's a claim that they are a non-U.S. person. They're the beneficial owner of the income, and the income that you're paying them is effectively connected with a U.S. trade or business. In this case, they're taxed just like any other U.S. person, graduated rates, they get the deductions. So in this case, with very limited exceptions, there would be no withholding, and you're just going to report on the 1042-S, and just like the IRS matches up the 1099s with our tax returns when we file to make sure that we've reported all our income, the IRS does the exact same thing with the 1042-S, and they match it up with the non-U.S. person's tax return to make sure they're reporting that income. Then we've got the W-8 EXP. I wouldn't expect in normal accounts payable for you to see this form very often. This is a form that would be provided by a foreign government or a foreign tax exempt where they're claiming an exception under Section 892 for a foreign government or a 501c3 for a tax exempt. And then just the next form, that's the W-8 IMY. And this is where you're talking about the payee versus a beneficial owner. This is going to be provided by someone who is a payee, so a non-U.S. intermediary. They're acting as an agent or nominee for someone, or a partnership or other flow-through entity. So a simple trust or a grantor trust that's non-U.S. They would use this W-8 IMY to convey to you that I'm not the beneficial owner of the income. I'm accepting it on behalf of the beneficial owner. They would attach the underlying documentation for each of those beneficial owners, and then they would attach a withholding statement that would, among other things, allocate the payment to each of those underlying owners, and then you would withhold and report directly to those persons based on that tax documentation that they're passing up. And then the final form is this 8233. This is really the oddball form. We've been lobbying with the IRS for over a decade to get rid of this form because it's just so much more difficult. And this is provided by an individual that's performing independent personal services, and they're claiming a treaty benefit. The reason this is the oddball form, all of the other forms, you just accept them, you validate them, and you stick them in your file. And if and when you're ever under exam, you would show them to the IRS. This 8233, you have to validate it and then send a copy to the IRS. You have to wait 10 days. If you don't hear back from the IRS within those 10 days, then you can make the payment and reduce the weight to 0 under the treaty. And the other reason this is the oddball form, most of the other forms are valid for the year signed plus the next 3 full calendar years. The 8233 is only valid for 1 year. So each year you've got to get another 8233 and go through that process of validating it, submitting it to the IRS, waiting the 10 days. So it's really much more onerous. And again, you know, we will continue to lobby to get rid of that so that these individuals could just use the W-8 BEN to claim the treaty benefit. So hopefully one day we'll win on that one. So then the actual withholding, as I've mentioned a couple times, the statutory rate is 30%. It's gross basis. Unless you've got documentation on file to support a reduced rate. And again, if you don't have the documentation or the documentation you have is not valid for some reason, you have to apply the presumption rules. Normally, if the payment's going to an individual, the presumption is going to be that they're a U.S. non-exempt recipient, and you would impose backup withholding at 24% on any U.S. and non-U.S. source income paid to that person. If it's going to an entity, then you would be looking to see if you've got foreign indicia. In the accounts payable world, usually the foreign indicia we would have is the address that you would communicate with them as a non-U.S. address. And then if so, you would presume them to be non-U.S., and then you would be imposing the 30% withholding. And I know in this day and age, oftentimes there isn't physical mail being sent. And the IRS's position on that, it's not in the regulations or anything, but they have informally said at withholding conferences and whatnot. It would be what address if you were to mail them something, knowing that you're emailing and whatnot. But if you were to actually send them physical mail, what address would you use? And that's what you would be looking for the presumption rules. Now, here's the tricky part of with the presumption rules. You have to withhold in accordance with the presumption rules, or mandatory, unless your actual knowledge is actually going to result in a higher rate of withholding. Now, it doesn't happen a lot, and it was designed to not happen, but these rules were written way back when the backup withholding rate was 31%. So they were designed then when this would not come up, but now every once in a while we'll get a situation where your actual knowledge is in fact going to result in a higher rate of withholding. And one thing to note for individuals, you might have a situation where you have to treat the same person two different ways. So for example, if you don't have the proper tax documentation and you're making U.S. and non-U.S. source income payments, but you have actual knowledge they're a non-U.S. person, you would have to withhold 30% because your actual knowledge is higher than the normal backup withholding rate at 24%. So on the U.S. source income, you would withhold 30%, but because under 1441, there is no withholding on non-U.S. source income, you would have to presume them to be a U.S. non-exempt recipient and withhold 24% on the non-U.S. source income. So it can get very convoluted. So the key is get the valid tax documentation up front so you don't find yourself in this scenario. So next, I'm just going to move into persistent misconceptions that we see in this space. All right, I'm going to have another polling question first. That polling question is, how do you calculate withholding?
Poll question number 3 is now live. We're going to leave this open for long enough to get a majority of responses. Everyone go ahead and vote on poll 3. If you're having any trouble answering the poll, go ahead and let us know in the questions area. We'll do the best we can to help you out as quickly as we're able. But in the meantime, poll number 3 is now live. We're going to close out of this poll in 3, 2, and 1.
Okay, I'll move on now. So some of the misconceptions we commonly see with the W-9 is that the entity status must be completed. That's actually not true. The regulations for a valid W-9 say you have to have the name, a TIN, an address, and a signature. So you can have a valid W-9 if they don't give you that entity type. That said, if they are giving the entity type, which normally they do, you've got to make sure that it's consistent. So, for example, if they check that they're a partnership, but they've also used the payee, the exempt payee code that they're a corporation, that wouldn't necessarily invalidate the form, but you would have to do information reporting. You could not treat them as an exempt recipient because they've indicated they're a partnership. Same thing if they're saying that they're an individual or sole proprietor, but they didn't check that appropriate box. So if they do that, you've got to make sure that you've got consistency on that form. And so if there's not, I would go back and get that corrected. Another misconception here on a W-9 is that the address has to be a U.S. address. No, it doesn't. On a W-9, we don't care. You're certifying your U.S. There's going to be 1099 reporting. The IRS is going to match that up with the tax return. So the address just doesn't matter. And then the final one, this one's a very odd one. And unfortunately, it sticks around. We've asked the IRS about this many times, but haven't gotten any movement there. The instructions to the W-8 forms, those forms provided by non-U.S. persons, the instructions say if the person didn't date the form, the withholding agent that's receiving that form can date stamp it on the date they received it. And the reason that's important, of course, is because there's a validity period. And so you need to know when that time starts ticking. For the W-9, there is no such rule. And remember, the regulations say it's name, TIN, signature, and date. And there is no provision that says that the withholding agent or the payor in this case can date stamp it. So if they didn't put the date on that form, then we just don't have a valid W-9. So that's one that's often overlooked. Then on the flip side, the W-8 misconceptions. The Box 2 has the country of formation that's required. And one of the misconceptions is that can never, ever, ever be a U.S. address because they're certifying to be non-U.S. Now, that would be the general rule, but there's certain circumstances if the entity was a trust, for example, because to determine whether a trust is U.S. or foreign, it's a two-pronged test. It's not where the trust is organized. It's a court and control test. So what court has jurisdiction and who has control? And if both of those are non-U.S., a non-U.S. court and a non-U.S. person has control, that would be a non-U.S. trust, even though it was organized in the United States. And the other one is an international organization. Again, I wouldn't expect you to see that in the accounts payable world, but I suppose it could happen. And they could have a country of organization as the United States. The next misconception is that the FATCA status is always required. For any of you that have been in this space for a long time, you know that what FATCA came to be, that W-8 Ben that was the one pager for an entity has morphed into an 8-page form, and it's quite complex. But if you're not making a withholdable payment for FATCA purposes, which is really and I won't get too far into it, but it's really a FDAP payment that's financial in nature, interest, dividends, fees on financial transactions, things like that. If that's not being made and it's just your normal accounts payable, you don't need a Chapter 4 status. And in fact, you can create a substitute form that removes the FATCA certifications altogether. And the regulations say this is permissible, that you can create a substitute form that is purposed for the transaction, which would mean if I'm not making a FATCA withholdable payment, I don't need any of those certifications. One good thing that came about in the burden reduction regs in late 2018, when the FATCA rules first came out, insurance premiums, regardless of the fact that they weren't on a cash value product, so just your property and casualty insurance premiums, even though they're very much non-financial in nature, they were withholdable payments, and that was one of the payments we would see being made through accounts payable where you would need that FATCA status. In the burden reduction regulations that came out in December 2018, the IRS changed that rule and said that if it's insurance premiums on a non-cash value product, so a term life insurance would be non-cash value, your property, your casualty, medical, that would not be a FATCA withholdable payment anymore. So you could use these short versions of the form and you would not need the FATCA statuses. And then finally, that the permanent address cannot be a P.O. box address. Now, that is the general rule, and that is what the instructions say, but there is this notice 2001-4, and it still is in effect, that says if the withholding agent does not know or have reason to know that a physical address is available and doesn't know or have reason to know the person is a U.S. citizen or resident, the P.O. box is okay. And that's really because there are some certain countries that don't actually use straight addresses. And then there's also, I was actually still with the government when this rule went into place, and it was because industry came to us and was pointing out, like certain rural routes in Canada don't use physical addresses and instead use P.O. boxes. So that's the reason for that rule. If there's a care of address, that's still going to be a problem unless you've got documentary evidence to show that that's their registered address, or the care of address is their registered agent. Just a couple more misconceptions. One is that U.S. addresses must always be cured. So again, your job as the withholding agent is you validate the form, but then you have to make sure that there's nothing inconsistent in your files. So if there's a U.S. address normally on the form or in your account files, you would have to get additional documentation to cure that U.S. address. That being said, it's only for beneficial owner withholding certificates. So on a W-8 IMY, where the person's saying I'm receiving this payment on behalf of somebody else, we don't care if there's a U.S. address on that form. And then a W-8 ECI, if you remember when we discussed that, that's the non-U.S. person is telling you this income is effectively connected with their U.S. trade or business. So you would actually expect a U.S. address on that form. So that's one area where you would not need to worry about curing those U.S. addresses. In all the other cases, you would need to. And then unlike domestic payments, for domestic payments, if you don't have the TIN on file in the manner required, so again, whether you needed it just a TIN or on a W-9, there's no ability to cure after the fact. If you didn't have it, you needed to impose backup withholding. And if you didn't, you're liable for the backup withholding. On the non-U.S. side, there's actually a benefit here. If I didn't have a valid tax documentation, I can get what's called retroactive tax documentation. And that's really just the W-8 form with an affidavit on the bottom where the non-U.S. person certifies that the information on that form was true and correct back at the time you made the payments to them. Back when the FATCA regulations came out in 2014, they had what was called a coordination regulation package, where they coordinated the FATCA rules, which was Chapter 4 of the code, to the Chapter 3 rules, so the 1441 rules. And when they did that, they added an additional requirement for this curing, these retroactive forms. And that is, if you are curing the payments more than a year to the time, so you're getting that retroactive tax form more than a year after the time you made the payment, you actually also have to get documentary evidence that supports the claims they're making on that form. So a residency certificate, articles of incorporation, things like that. So again, just important to look at. And this is something that on audit, the IRS is insisting on this when the tax documentation is collected more than a year afterwards. So an additional hoop that you need to worry about if you find yourself in a situation where your tax documentation wasn't valid when you make the payment. And then again, I think we've covered this, but just to hone in one more time, that if you don't have the valid documentation on file, the presumption rules are mandatory for individuals. Again, it's generally going to result in 24% backup withholding on all payments, U.S. and non-U.S. source income. And then for entities, it's going to depend on what type of indicia. If you've got non-U.S. indicia, you're going to treat them as non-U.S. And if there is no non-U.S. indicia, you would treat them as U.S. and backup withholding. And then again, if your actual knowledge is going to result in a higher rate of withholding, you're going to go with your actual knowledge. I'm briefly just going to cover some COVID impacts. We didn't see a lot of COVID impacts with respect to Chapter 3. For foreign financial institutions that had FATCA reporting and common reporting, standard reporting for accounts of U.S. persons outside the U.S., we saw a lot of relief. We saw a lot of delays in the reporting, and we still, every day, we see countries announcing additional delays. We think for the 1042 and 1042S, we didn't see that because if you were on the first, if you were going to stick with the original due date, March 15th, you probably had everything done before we were shut down. For those that asked for the additional, the automatic 30-day extension, they probably, you really find yourself in trouble because, by the time everything was shut down and we were working remotely, most people then didn't have access to the systems and the data they needed to get those filings done by April 15th. We've talked to the IRS a lot about it. There's a lot of industry groups that have been in communications with both Treasury and the IRS on this issue. And the IRS has informally anyways said that, they didn't intend to come out with any formal guidance, but they intended to be very liberal with penalty relief. We're hoping that they're able to program the system so that we just don't get the computer-generated penalty notices. But if you do, just a request for abatement of penalties based on reasonable cause should be accepted. We do not expect, based on what they're telling us, that there will be any problems in that area. And in fact, industry's been asking for just a standard template for the abatement of those penalties. So if any of you are signed up for the announcements from the IRS in this space, and if you're not, I would encourage you to do so. They have emails for any type of information coming out with respect to information withholding and reporting. You can sign up on their website. You will be notified by that if they're going to come out with a template. But anyways, just rest assured that we're hearing that there will be liberal penalty relief because they did not formally do any type of delays. And then the final section, I just wanted to do a little bit of a deeper dive as to what we're seeing on these 1042 audits. Just going to the next slide. So they have an updated internal revenue manual. I would encourage any of you that would be responsible for overseeing an IRS Form 1042 audit to actually go look at these, because when you read through, they're broken out. It's bifurcated for financial institution audits and non-financial institution audit, so accounts payable. And when you read through the steps, I can assure you that these examiners are following them to the T. When I read through them, I almost chuckle because it's just exactly what's happening on every single exam that I help with. They've targeted certain areas. I've got them listed here, and that's exactly the non-financial areas that we're seeing targeted right now. They will expand out. Now, of course, with the COVID, we've got the delays because they're working remotely as well. We are seeing them very active with ongoing audits. So people that had already started the audit, they have continued those in earnest. But we're not seeing any new ones right now, and won't expect to until we've got some normalcy going back on. But they're definitely very active in this space right now, and you should be aware of it because there's certainly things that you can do ahead of time to prepare yourself. And I was talking about the ability to obtain retroactive tax documentation in this place. So during an audit, it doesn't mean that you don't have time to go track some down, but usually you don't have a lot of time. And so if you are checking these things internally ahead of time and really preparing yourself for an exam ahead of time, you're giving yourself that luxury of time to be able to go remediate to the extent you may need to. So what we're seeing is the exams are now being managed by the regional teams. So we've got 9 teams across the country. They are supported by a key New York group in Manhattan, and that's the group that has always been examining the financial institutions in this space, which historically the IRS exams were limited to the financial institutions, but now, as I mentioned, much, much broader. The one thing that I'm seeing just within the last year and a half is the IRS is really doing their homework before they have any kind of communications with the taxpayer. So they're diving into your websites. They're seeing the types of your business activity. So when they're coming in, they're asking very detailed questions about the payments that you're making instead of you just telling them what you're doing and them relying on that. So they're doing a deep dive. They've also got some new software that they can, for lack of a better way to describe it, slice and dice up the information on the Form 1042, and they're targeting areas where there's anomalies. So, for example, if you are reporting that the recipient code is 08, a foreign partnership, but you've given treaty benefits, there are a situation where that could be right, where a partnership may be a hybrid, and entitled to treaty benefits because it is a resident and subject to tax in its own jurisdiction. But there's a special code for that, for hybrids claiming treaty benefits. So if they see just a partnership and a treaty claim, they're able to use the software to see, oh, this doesn't look right, and they'll target the audits to these specific areas where they think they've identified some non-compliance. The audits now are going far beyond being form-driven. Historically, the exams were, just a review of tax forms. Were the I's dotted and the T's crossed? Did you do everything you were supposed to do with respect to the forms? Now, that being said, they are still very, very particular about the forms. Years ago, they were talking about the way they would term it was clearing the underbrush, and that meant, not dinging withholding agents for the gotchas, some minor foot faults on the form. We didn't really see them get away from that. They are still very particular about those being completed very appropriately. But what we are also experiencing is they're doing a much deeper dive into character and source. They're reading those contracts. They're digging through the statements of work, and they're determining whether you were correct when you said something was a sale versus a royalty or a services versus a royalty. So we're seeing the audits being much more substantive than they had been in the past. They're also, for the non-financials, they're looking at your 5471, your payments to your related parties, your non-U.S. related parties. Oftentimes, that's non-U.S. source income, but it would be a good thing. There's the Schedule M where you've got the details and the worksheets for all those payments. It's a good thing to be looking into that ahead of time because they're going to be asking questions about that. And they want to know, were you withholding? Oftentimes, the payments between related parties, there aren't physical payments. There's just offsets on the books and records between the group of companies. But for purposes of withholding and reporting, that there's a deemed payment when those offsets were made, and there needed to be withholding or certainly tax documentation if there was a treaty benefit and reporting. The other thing we're seeing on exam is reporting penalties. Historically, if the withholding agent got the income and the tax correct on the Form 1042-S, but the codes weren't correct, we never saw them impose penalties. And now we are definitely seeing penalties imposed for very minor errors, in my perspective, on the Forms 1042-S. So that's another thing that you should check as you're going through to see what you've done in the past, because it's something you can correct. So that's important. One thing to say on a good side, the IRS has been very reasonable with the amount of time that you're giving to collect the data for an exam. But that being said, make sure that you ask for draft IDRs. Make sure you completely understand what they're asking in the IDR before they issue it in final form. And if you think you're going to need additional time, once you see that draft IDR, discuss how much time you're going to need. Because like I said, I've been seeing them be very reasonable with allowing additional time. But once that final IDR is issued, it's very difficult for them to go back to their management to get approval to extend times. But they've got all that leeway ahead of time and can give you additional time before they finalize the IDR. So make sure you can talk about that. And if you think it's going to take some time to get some data, or there's other things going on, sometimes they don't understand, how busy you are during information reporting season, and they'll come ask a withholding agent that's in the midst of that, to start undergoing the data gathering for an exam. And so make sure you discuss that and get those in draft form so you know what they're asking and how long it's going to take you. As far as extrapolation, the IRS has, for a while now, when it's sampling, they've been removing all payments where you subjected the payment to 30% withholding, and they're also taking out de minimis payments. So depending on how large your payments are, anywhere from anything less to 500 to 1,000. We've even seen everything under 5,000 if you've got substantial volumes of payments. They really want to focus on the areas where they think they're going to get some tax from you. We've argued for a long time that it's just simply not fair to take out all payments subject to 30%, but they have been adamant about this, and they continue with that practice. On the flip side, the good and the bad. So that was the bad, some of the good. When they're extrapolating, so let's say they've identified errors and they want to extrapolate those errors across the population. Years ago, they would extrapolate the underwithholding, and then to the extent you cured, remember I was talking about that retroactive tax documentation with the debt, and you can even be gathering that during the exam to the extent you can. Usually they'll give you 60 days. But years ago, they would extrapolate the underwithholding and then subtract out the cure. So let's say the extrapolated underwithholding was $100,000, but you were able to get a retroactive W-8 then that was $1,000 of tax. They would just take off the $1,000 from the $100,000 proposed liability. They will now extrapolate the cure. So in this case, they would subtract out that $1,000 before they projected across the population. So that actually is extremely helpful. But then again, the good with the bad with the good. The bad with that is we're seeing proposed extrapolations with very low error rates. Error rates where I think the withholding agent's doing a fabulous job, and we're seeing, even 2 and 3 errors with quite large samples, and they're proposing extrapolation. So just in the last slide, why is this important? Because to the extent you can prepare ahead of time, you can save yourself a lot of headache. You can make sure you've got policies and procedures, read them, make sure that they are current. We've had changes in this space. Make sure that you're reconciling Forms 1042 and your 1042-S. If you've got large volumes of payments, you might even want to consider that on a monthly basis, but definitely on a quarterly basis. You don't want to be reconciling, something that happened 3 years ago when the IRS comes in now. And then again, look at that 5471 if you've got foreign entities that you're making payments with, and make sure that you've withheld where appropriately, or at a minimum have the proper tax documentation. And then what you should do, the most important thing is know where you stand before the IRS comes in. You don't want to be discovering the errors as they're discovering the errors. Do a health check. Pick a sample of payments and go through it from beginning to end. Determine the character and source. Did you get it right? Look at the tax documentation. Does it support the level of withholding that you imposed? Did you do the reporting right? If you find you've got some problems, remediate. You can go get the retroactive tax documentation. You can amend your form. And you can also consider a voluntary disclosure. If you determine at the end of the day, I didn't withhold, there's no treating reduction, it's just 30%, you've got a process in place where you can go in, and it's a quite simple process. And, they've been very liberal with penalty abatements because you're coming in voluntarily. But again, the critical thing that I want to say is just know where you stand before the IRS comes in. And again, because on these cross-border payments, you have the opportunity to remediate, it's important that you go through that process whenever you can. And with that, I'm going to turn it back over to Anand.
Thank you, Laurie, for the compelling content, great advice, and great best practices. I know it was a lot to take in. The good news is that we are recording this webinar, and it will be available to the viewers later. And, in the next section, I will provide highlights about the Tipalti solution. So since this event is specific to tax, I will begin with our tax module, which of course is KPMG approved. So Tipalti solves the complex and highly manual process of collecting tax information, basically through a digital capture directly during the supplier onboarding, which ensures that the information that is collected and validated before the payment is processed is accurate. And you can require all payees to fill out forms with the tax forms or provide their VAT or local tax ID as a part of self-registration on the Tipalti portal. So our guided tax form wizard helps suppliers of U.S. payers select the correct tax form based on the country and the business structure. And once the correct tax form is selected, Tipalti basically digitizes the tax forms and applies 1,000+ rules, including PIN validation, to ensure that the proper data has been provided. And at year end, Tipalti generates the 1099s and 1042X, the S tax prep reports, and calculates the necessary withholdings. And for non-US payers, Tipalti collects and validates local and VAT tax IDs in 49 countries. And just a quick caveat before I move on, it's important to note that we don't provide tax advice or do tax filing, although we have partners who do the tax filing for you. And any tax-related information that I'm covering today should not be construed as tax or legal advice or investment advice as such. So I wanted to give you a quick overview about the Tipalti platform. So this is the Tipalti wheel, which basically highlights a philosophy that if you put a robust system in place now, you will not outgrow it as you scale. So we provide an end-to-end solution to manage the entire payables operations. So as you can see on top, it starts with the supplier management with self-service supplier onboarding, which includes over 26,000 built-in rules and validation to ensure that the payments data is accurate. You can white label the supplier portal so that your brand is up and center in front of your payees. And as I stated earlier, we have a KPMG approved tax compliance engine that identifies and collects the tax documents such as the W-9s and W-8s and generates the 1099s and 1042S tax prep reports, and also calculates the necessary year-old withholdings. The solution includes invoice processing with OCR technology and machine learning to ensure that it's touchless or straight-through invoice processing, if you will, along with advanced approvals. We have a 2- and 3-way PO matching for PO-backed invoices. We are also a licensed money transmitter and pay across 199 countries in 120 currencies with 6 different payment methods. We do sanction screenings to ensure that you don't pay anyone who's on a terrorist watch list or who's listed as a money launderer somewhere. We have robust reporting with more than 20 out-of-the-box reports with real-time multi-entity payment reconciliation with ERPs, which basically ensures that the financial close is a lot faster. And that now is our early payment solution, which is built into the system. So you can generate revenue on your AP side by paying suppliers faster or earlier without adding to your workload or impacting your working capital. The one last capability that I wanted to highlight was also that you see basically the service foundations area is the multi-FX or intercompany bank transfer capability. So you can save time and money on foreign exchange or FX conversions. So it's ideal for companies with multiple entities who are paying in different currencies globally. Essentially, what Tipalti does is it converts the currency that it's funded in into subsidiary currencies and processes the payouts, basically. And all this is built on the Tipalti platform, which ensures proper financial controls are in place with all the compliance that we manage. So here's the sample list of our customers, ranging from fast-growing startups to established companies across various industries that are benefiting from Tipalti. Our customer satisfaction rate is 98%, which is by far one of the best in the industry, and we are proud of it. And the ROI includes eliminating 80% of the payables workload with the current technology that is in place, and reduction in payment errors by over 66% with all the intelligent data capture and the payment validation rules that are built into the system. And basically accelerating the financial close by 25% with real-time reconciliation with ERPs such as Oracle NetSuite, Sage Intacct, and QuickBooks Online. So that in a gist is basically about Tipalti.
All right, we're going to go ahead and jump in for poll question number 4. This is the fourth and final poll question. We're going to make sure we leave this open long enough to get a majority of responses. If anyone's having trouble answering poll question number 4, go ahead and let us know in the questions area. We'll do the best we can to get your troubleshooting done quickly and make sure you have the opportunity to answer this poll. But again, this is the fourth and final poll. This is the final opportunity to answer a poll for credit. So go ahead and get your answers in now. We're going to close out of this poll in 3, 2, and 1.
Okay, with that, I will open it up for Q&A. And as I was monitoring, as Laurie was basically presenting her section, there are quite a few, in fact, many questions, Laurie. So let's see how many we can cover in the remaining time that we have. So Laurie, the question basically relates to you. So if we have made payments related to related parties to a company in a treaty country, but we have no W-8 on file, will we have the ability to cure it after the fact?
Yes, absolutely. So you can get that W-8 Ben E where they complete the treaty section, so you have a valid treaty claim, and they then must have the retroactive affidavit where they're certifying that the information on that form was true and valid at the time you made those payments. And then there's the statement says if something was different, then you attach a statement and say what was different. So for example, if their physical address was different back at the time you made the payments, but they're still in a treaty country, they might want to attach a statement and just say that. And then again, if it was more than if you're getting that retroactive form more than a year after the time you made the payment, then you would also need that documentary evidence. So a copy of their organizational documents, or it's also if there's a government website that has a printout of the information of where they're organized and whatnot, that qualifies as documentary evidence, or a residency certificate. But if it's more than a year, you got to remember to go through that additional step.
Great, thanks. So the next question, Laurie, is if we receive a W-9 form with foreign address, do we have to withhold tax from payment?
No, absolutely not. We do not care what the address is on the W-9. I think in the IRS's view, especially since BATCA came about, being a U.S. person is about the worst thing that you could certify to be. So, yeah, we don't care about the address as long as we've got the name, the valid PIN, the signature, the date, you've got a valid form, and you would just do the 1099 reporting, and there would be no need to do any backup withholding or any other reporting. They've given us everything that they need to give us at that point to have the payment made tax-free.
Great. So next one, Laurie, is there are lots of questions that are coming through, and I'm going to be quick on this. We still have time, though. So what if it is an individual who has a company, ticks off LLC, however, fills in FS as opposed to FEIN? Should that be treated as an individual, not a company?
Yeah, this is a common reporting error. So the IRS a few years ago tried to modify the W-9 because this was a big problem where people were either giving the name of their LLC and giving their social or vice versa. They were putting their individual name, but they were giving the EIN of their company. And so you were getting B notices because there was a name TIN mismatch. Unfortunately, the change to the form and the instructions to the change aren't as clear as they probably could have been, so we're still seeing that. So in this case, I would certainly recommend that you use that IRS TIN matching program so that you know ahead of time if they've done this, so you can go back and get that corrected so that you've got the name TIN correct before you're actually reporting on the 1099 to the IRS. So yeah, just know that is a very common problem that still plagues the industry. And so that's where I think, again, the TIN matching program is ideal to make sure that you get that corrected before you have to report to the IRS.
Right. So I'm not too sure about this question, but I'll read it anyway. So US dollars used to pay for non-US based services still need a W-8 DENE, but withholding will not be necessary, correct?
So it's non-US services, as long as you've got that service statement. So again, either in the contract, the statement of work, the face of the invoice, or a statement from the service provider, and the IRS will even just accept an email certification. As long as they certify that all services are performed outside the U.S., that's right, you'd have no withholding, no reporting. Let me take a step back on that. There is a presumption rule. So if you've got if it's an entity, and you've got non-U.S. indicia. So again, in accounts payable, as I mentioned earlier, it's normally you would have the mailing address. If you want to mail them something, it would be a non-U.S. address. If that's the case, you would not need a W-8 form because you get to presume them foreign, and now you've got the statement that they certified to you that all services are performed outside the U.S., so you're fine. There is an exception for an individual. As I said, the general rule for a payment to an individual, if you don't have tax documentation, is that they're a U.S. non-exempt recipient. There is one exception to that, and it's for services. So if you know the services are performed outside the U.S. because they gave you this statement and you don't have any U.S. indicia, and so you don't know or have reason to know they're a U.S. citizen or resident, you can be non-U.S. and you'd have no withholding, no reporting. I will caveat that with, I still believe it's best practice to get the W-8 to establish the non-U.S. status. And the reason I say that is in accounts payable, oftentimes they're going to get pushback from vendors saying, well, nobody else makes the W-8 form, and why are you asking me for this? And they may not know at the time that they're giving that payment, at the time they're setting up that vendor, what exactly is going to be paid to that vendor. And it's a whole lot easier for your accounts payable team to just be able to say, it is our company policy that we do not set up a vendor without a W-8 or W-9 form. Because then they don't have to know upfront and to be having that battle. And another problem is, when you first set them up, it may be non-U.S. services, but then they might come to the U.S. for some meetings or whatnot. Now we've got to allocate some of that to the U.S. So having that form up front, I do just think it's best practice. I always recommend use the presumption rules as your safety net in case something went wrong. But the general practice should be to be getting those W-8s and W-9s.
That's great advice, Laurie, and best practices as well. So on similar lines, someone is asking if they can process a payment to non-U.S. personas or entities with no withholding certificate as long as they withhold 30%.
Yes, that would work. But again, keep in mind if you don't, because again, we're in the presumption rule. So as long as you had the non-U.S. indicia, yes. The problem would be if for some reason the presumption rules is going to result in you having to treat them as a U.S. non-exempt recipient, because now you've got backup withholding on both U.S. and non-U.S. source income. And so that's just the one caveat I would warn with. But as long as you had the non-U.S. indicia, so you got to treat them as non-U.S., yeah, you could just withhold 30%. And if you didn't have a valid form, that would be okay. You may have a customer relationship issue, but you don't have an issue with the IRS.
Yeah, that you can deal with, I guess, rather than dealing with IRS. I think that's easier, potentially. So, on the W-8 documentation, Laurie, so there's a question, if you have a W-8 documentation on file for all the foreign vendors, does it mean a 1042 is not needed? And if not, when did you give them advice to use the Form 1042?
Okay, so the W-8 is your tax documentation. If you're making U.S. source payments to that person, even if you don't have to withhold for some reason, so that because let's just make up an example, it's a non-U.S. entity, they perform services, they gave you a W-810E and claim 0 under the business profits article. I have no withholding, but I still have to report on both the 1042. So the place on the 1042, normally the 1042, anyone that's familiar with it, the majority of the form is you're showing tax liability. Here, I didn't have any, but there is a line for gross income. So I've got to include that payment in the gross income line. And there absolutely is a 1042S, that information report return, one copy going to the IRS and one copy going to the recipient. Even though you didn't have to withhold tax because there was a valid treaty claim, you've still got to report.
Excellent. So I think we just have a few more minutes left, Laurie, but I'll put you in a little bit of a spot, basically. So what are the top 3 things that companies can do, just the best way to stay on top of tax regulations, the best practices, you talked about it, to make sure that they are compliant and they can sleep better at night?
Yeah, like I said, I think that the most critical thing, of course, we talked about tax documentation is the cornerstone to this entire regime, to make sure that you've got good processes in place for collecting it. And it's not just collecting it, it's validating it, which means, is the form facially correct? The 4 corners aren't inconsistent. But then you also need to vet it against the other business data you have. You're not an investigator for the IRS. You don't have to go out and be doing internet searches to make sure their claims are valid. But the information that you get for business purposes, you have to compare that to what their certifications are to make sure it's valid. And just to make sure that you've got processes in place, again, that somebody is determining the character and source of the income before the payment's made, they're getting the tax documentation before the payment's made, and that they're carrying that through to get the proper withholding and the proper reporting. Again, just because for the IRS, it really is the low-hanging fruit. It's an easy exam for them. And the beauty of it is it's fixable. Most of it can be remediated if you didn't have strong processes in place. You can get them in place now, and you can fix your past errors.
That's great advice, Laurie. So we are at the top of the hour, and I think we covered quite a few questions, and there are a few that we could not get to. I apologize, but hopefully somebody from Tipalti will reach out to you with the responses. And please do feel free to reach out to us if there are any questions. And that basically concludes the webinar. Laurie, thank you very much for the compelling and engaging presentation and the best practices. And I want to thank everyone for, sure, it was a pleasure. And thank you everyone for taking the time to attend today's event. Have a great rest of the day and stay safe.
All right, Anand, Laurie, thank you both so much for that informative presentation. Of course, thanks to everyone in the audience as well for your time and attendance. We are going to wrap up quickly as we're just over time. We here at CPA Academy are going to process CPE by the end of the day today. CE we will register with the IRS at a later date. Everyone will have the opportunity for a full webinar evaluation. Those links are in your email as well as in your CPA Academy accounts. Thanks, of course, to Laurie and everyone at KPMG and Anand and everyone from Tipalti for bringing today's webinar to all of you today. We hope to see you all on future webinars and hope you all have a great rest of the day.